Ladies and gentlemen, welcome to this public lecture organized by Boon Institute for Financial Economics, or SKBI, at SMU. SKBI was founded in 2008 to really promote study in financial economics and financial econometrics in areas that are strategically relevant to Singapore's economy and the economy of the region. One of the main objectives of SKBI is to support Singapore's ambition to be a major international financial center. We also hope to anchor SMU to be a major think tank on financial economics. We have, the Institute has 4 research centers to study financial econometrics, silver security, corporate governance and investors' responsibility, and lastly, asset securitization and management. We are only, as you can tell, we are only 3 years old. I hope that's my age. However, we are quite proud of our achievements so far. For instance, the Center for Financial Econometrics has published many papers in leading academic journals in recent years that has helped SMU to rank number 5 worldwide in econometrics by the most recent Tilburg University ranking. The financial market today is quite different from before in many ways. Given that what has happened in recent global financial markets and what is happening right now in Europe, investors, regulators, and the academics must adjust themselves to a new world where even some of most fundamental theory in financial economics is in doubt. Based on these challenges, SKBI is very keen to bring the best research talent from around the world to Singapore to share with us their ideas, their research outcomes. And of course, we hope to work with you. We hope to engage SMU faculty and the students to work with you. This applies to industry partners because you have a real world problem to solve. So we like to know your problem. Today is my honor to introduce to you a real thought leader in the profession, Professor Hashem Pesaran. Professor Pesaran is currently a professor of economics at Cambridge University. He is concurrently holding a John Elliott Chair at University of Southern California. He was the head of a research department of Central Bank of Iran and the vice president of a Tudor Investment Corporation, which I guess is a asset management firm based in Connecticut. This unique set of experience, I guess, must be very helpful to Professor Pesaran to look at financial problems from multiple perspectives. Professor Pesaran is the founding editor of a Journal of Applied Econometrics, a leading journal in the profession. He has published more than 130 articles in academic journals and several books. He is the Fellow of the Econometric Society, Fellow for the Journal of Econometrics, Fellow of the British Academy. Okay. Today, he's going to share with us one challenge the entire profession of financial economics is facing, which is efficient market hypothesis. Ladies and gentlemen, please welcome Professor Hashem Pesaran.
Thanks so much, Professor. Oh, that's fine. Thanks so much, Professor John.
The red one is the...
I think, yes, thank you. And thanks so much for inviting me to share some of my ideas concerning market efficiency and predictability of stock returns. Although the talk is titled Predictability and then Efficient Market Hypothesis, I'm going to start with reverse order. I'm going to now discuss what I think are the main premises of market efficiency in a very general setting, try to clarify some of the assumptions that underlie, in particular, for understanding markets and for predictability, and find out the condition under which predictability could arise, and the condition under which that predictability could be exploitable for making profit. Because not all predictability can be valuable. So without further ado, I will move on, and then after I have covered this topic, I will look at some empirical evidence. This is where I always believe that the theorizing without measurement is not good enough. And one of the reasons that some of the advice of macroeconomists based on calibration did not lead to a better understanding of when the financial crisis arose is because they really insisted on knowing the parameters of a model without linking it to the data. And given the center we are just discussing, the econometrics, is really the way how you measure, or at least find out the condition under which you can measure these relationships. So I'm going to also address that. I'm going to look at both evidence of the macroeconomic nature and the microeconomic nature. And based on the two papers I have written, one is forthcoming in a volume. Another paper is I presented at Princeton, is not yet released on my webpage. I tell you a little bit about that. Okay, so that's what I'm going to cover. And there would be hopefully enough time to discuss, but if anybody wants to raise any question while I'll present, which is clarifying nature, I'm happy to take those questions as well. So this is basically the program that we're going to go through. Now this, obviously the concepts of market efficiency been discussed by many leading researchers in finance and economics. And here I have just basically collected, from my point of view, what I consider to be important empirically for predictability. Of course, the issue of market efficiency is also relevant for valuation of assets, for looking at investment projects, and so on. I'm not going to address those. I'm going to only look at market efficiency from the perspective of predictability. And I see market efficiency having been built on two major, if you like, premise, which you can generalize it to three, but basically one is rationality, which I'm going to define. Another one is arbitrage. A lot of finance nowadays also built on intertemporal optimization based on some utility function. I'm not going to go along that route. Although most of these analysis can also be cast in terms of intertemporal optimization techniques. I thought it's much easier to set out my thinking about this subject, just looking at two issues when you arbitrage. Most of you here could be involved in trading almost daily or in some part of your life, either in the financial market or outside the financial market. In order to trade, you need some expectation what the price is going to be in the future. So you can make a decision whether you trade or you don't. But you also need to be able to convince other side of the market that if you are a seller, there's a buyer for it, and if you are a buyer, there's a seller there in order to match. This is where arbitrage is. So therefore, it is the combination of the two forces of expectations and arbitrage which creates market conditions. That is why I don't like the idea of a representative agent. I don't understand what it means. How could you develop a theory of finance based on a representative agent? So I'm going to also address that under what condition the representative agent model could be interpreted. You need to work with market with many, many agents, sellers and buyers from different sides of the stand of the market. You may have a house and you think it's a great house, and you really love the house and you think it's worth, say, $400,000. But if you can't convince anybody that it is that much worth, your expectation, your view is totally irrelevant. At the time that the prices are set, both the buyers and sellers are compromised their expectations. They compromise what they thought it is worth. Otherwise, they wouldn't be able to sell it or buy it. So therefore, you have to bear in mind that the premise here is that investment rationality, that they use all of the information, they correctly update the beliefs and so on, are central to the efficient market hypothesis. Although, as I show you, for the market as a whole, you don't need all individuals to be totally impeccable and understand everything. There is some collective rationality is also an issue. This collective rationality, which I'm going to address, also really the key to understanding why you get bubbles or crises or basically events which are very unusual. And finally, as I explained, arbitrage is really important for understanding how these expectations and this market calculation on the part of different agents brought together at the point at which the market clears or the transaction takes place. And it's also very important to realize that we need this assumption that investors are not liquidity constrained. And many investigators, Markowitz and others, have shown that if you have liquidity constraint on the part of the agent, you could have another impediment for the arriving at some kind of equilibrium market clearing condition. Let me just now move forward and just say, just to illustrate how these three premises interact with each other, I'm going to initially start with a heterogeneous agent model, which I think is the right setup to work with, and see whether we can derive the representative agent model that finance uses as a special case of this and the condition under which that can be done. So let's just take there are MT traders. The number of traders could be time varying. I don't want to be too technical today, but I want you to set out the premise before I look at some data. So MT could be large or could be small at the moment. Now, imagine each trader decides on a risky security and a risk-free bond, I said, if it exists. So we're coming to the point that may not exist anymore. But let's just assume it at the moment. Now, denote the one period holding returns on these two assets, which we by RT plus 1. This is future dated, so therefore it shows it's risky, so you form the expectation at time t. And later RTF is dated t, is known at time t. In other words, you have a contract in bonds, so you know what the price is at which you draw the contract. So therefore, this is the usual thing, is an excess return that we teach all the students. This is what the excess return is. Now, it's conditional information set of the agent I, which is omega IT. But then I'm going to note this as expectation of the ith agent that has to be the same at the time that the trade takes place. But it has to be matches with the two things, which is very important, is the risk premium of that agent, which to do with the risk aversion coefficient of that particular agent. And also another coefficient, which is the cost per unit of funds invested, and that's to do with the cost of borrowing if there is liquidity constraint. So therefore, these two components could differ across agents, and usually does differ across agents. Also, the expectation conditional on the information of the agent need not be the same across agents for two reasons. One, they could have different information at their disposal. Second, they may process the same information differently. I've worked in hedge fund. Believe me, if you give the noisy data that asset returns are, very little signal in them for prediction, give it to two groups, they could come totally with different answers. So this argument that if you have the same model, the same ideas, the same board view, you arrive at the same prediction is totally false, because slight error changes between people's specification. You lead you to different outcomes. So therefore, even if all agents were rational, they use their information most efficiently, and they follow the calculus of probability without any mistakes, and still you get heterogeneity of expectations. Okay. That's fundamental to this issue. However, that doesn't mean necessarily there will be no market clearing, no more efficient market. So I'm going to show you that actually that's important, that you need heterogeneity, but that doesn't mean that heterogeneity negates market efficiency. Okay. So basically, the reason is the following. If I now go forward, now let's look at the representative agent model. What does representative agent model does? How does it fit with this setup I have just written? What the representative agent model does, it says there is a rational expectation such that all agents' expectation, which is I denoted, hat means is a subjective expectation as opposed to objective expectation. This E is taken expectation vis-a-vis some objective measure. This is hat means is taken vis-a-vis some subjective measure. Now, rational expectation imposes that all the subjective measures are the same as the objective measure. Why? I'll come back to that later on. I mean, is it reasonable? I think not myself, but a profession took it as if it's a datum. If you said anything against it, you'd be blackballed. So that's one big assumption. Then, if you make this assumption, the rest follows. Why? Because if you then say this individual information have a common set among them, which we call publicly available information, because this publicly available information by construction is embedded in the individual information, because it's public, all individuals should have it. By the word public, it means that all the same across all individuals. It's embodied in it. If you take conditional expectation of the subjective measure, conditional on the public information, then if you then calculate this, it becomes back to the representative agent model. Because then you can say, what is a representative agent? Is that agent who has got the public information. And that agent which uses the objective measure as opposed to subjective measure. So therefore, representative agent model makes two fundamental assumptions. One is that all agents' expectation basically of this become the same as this objective measure, and the public information is the one that we define market efficiency vis-a-vis. So we can ignore inside trading, if you like. Although we catch people for it, but we ignore it totally, naturally, because we say it's unimportant. However, notice here that when you do all of that, still the agents have different costs of transactions and different risk aversion. It doesn't matter because somehow, so long as this expectation of these things which are different across agents, still this I's is the same. So it imposes a third set of assumption that whatever there are cost differences, whatever there are differences of risk aversion across agents, conditional expectation that has to become identical because of this implies that. If you assume this, implies this. Go back to the previous slide, you get that. So that you can write a complicated model to arrive at this conclusion, but I prefer this because it automatically says that rational expectation imposes such a restrictive discipline that essentially says that expectation of all the cost differences has to be the same. They could differ, but their expectation has to be the same. Otherwise, the market would not be in equilibrium. So now if you argue then under this condition, we can then write down the result that most people have, that the market efficiency is defined that, okay, this is become the predictable component, and you say, well, you only need to use public information to predict excess return, but then if you use predict excess return because of risk aversion, it could explain risk aversion. So you can never reject market efficiency in this line of business. Because whatever predictability you have, it could reflect some risk aversion, variation of risk aversion over business cycle. This is the conclusion of the literature, in my opinion. Although people try, but I don't think, if you believe these things, you cannot reject it. You just can sustain your views. So that's basically what it says. So basically it says that since they have to be all the same, look, this side is the same, so this has to be equal to that. Remember, this is what each agent does. This is the arbitrage of each agent. Because they have the same common expectation of excess return relative to public information, therefore all the expectation of their differences in their cost and the borrowing cost and risk aversion differences have to all get washed away. They have to equalize at the time of trade. It's just mathematics. It just has to be done. Then that's become this is the result that is well known, as I just already explained. Let me just now go back and say, is it really meaningful if I now do not make the assumption that the expectation of the agents all become the same under rational expectation hypothesis? Well, actually, I argued that 23 years ago. There is a book I wrote called The Limits to Rational Expectation. People now gone back to this and keep asking me to give talks on it suddenly after 23 years. I'm sure if it was not a financial crisis, nobody would ask me to talk about this book again. But I would recommend you may want to read at least first 2-3 chapters. So I was saying this kind of thing many years ago. It's not just I came yesterday and decided to write about it. Okay. But my view is that really this mistake. My view is that the rational expectation hypothesis is rather extreme. Is unlikely to hold at all times in all markets. I'm not denying it could hold us sometimes. But to argue it holds all the time, I think is really folly. And if we insist on that, it stops us thinking about how the world works. Okay. So people have told me that, in financial market, learning takes place very quickly. I agree. It takes place quicker than other markets. But remember, markets has to be all aligned with each other. There are spillover effects. If you don't understand one market, it spills over into another market. But there are periods which are turmoil in the market. Participants, they are in the dark. They guess, they experiment. It's not clear that you get this outcome. It's very, very unlikely, in my opinion. Herding, correlated behavior, I'm going to discuss a little bit more about this, could also lead to further departure from this equilibrium condition, which I just wrote down. This is the key equilibrium condition. This is the key. Remember, I just derived this from heterogeneous agent under the assumption I just explained. So therefore, if you abandon any of those assumptions, this one no longer be valid. And I'm arguing that we should abandon those assumptions if we want to make progress. Doesn't mean you abandon market efficiency idea. You just admit that market cannot be always efficient. That's the only thing saying. I'm not saying it cannot be efficient sometimes. So that's not the point. And we will want to know under what condition it's efficient. So I'm going to go into that now. So I'm going to abandon the heterogeneity, the homogeneity, and I'm going to go back and try to develop the theory of efficient market under heterogeneous expectations. Okay. So let's assume now, because participants are not the same in terms of their views, we need to give them weights. Because it's important what weight each participant has in the market. Let's assume the weight of the ith agent in the market is WIT. In other words, it's the share of the asset held by trader I. And let's define xi-it to be the difference between the subjective beliefs of that agent, given his information or her information set, and the objective reality which we think is there. Although even the objective reality may not be there. But whatever that objective reality is. Let's call this just a deviation. These are xi. This is just a definition. Then define what I call the cross-section average. This cross-section average is the key in pooling of information in the market. So what the market does, it basically pools dispersed views people have in the market. So the xi-it would have been 0 under rational expectation. If it were 0, the cross-section average would be 0 by construction. But because xi-it is not 0, at least I'm not assuming it at the moment, you get this average coming in. But then if you then use this average, bear this in mind, it's just a cross-section average. I'm going to assume the WITs are granular. In other words, no individual in the market dominant. So everybody's 1 over M in the market. Then you can then think of the xi-it is the measure that shows how individual expectations differ from this unobservable concept. And then because of this, you could then, the key to understanding the market is to see what happens to this average. It's possible that each component of an average is non-zero. So in other words, the market expectation of agents differ. But it's possible that the average goes to 0. It's like a central limit theorem or the law of large numbers. But there has to be condition to be satisfied for the law of large number for this thing to go to 0 or go to a constant. Okay? So that's the key, in my understanding of the market. That instead of assuming all the xi's are 0, let's assume they could be non-zero and ask the question, under what condition the average goes to 0. Okay? Because I see the market pooling these differences. So the market could be efficient, even if the heterogeneity, even if the rational expectation does not hold in the sense that all expectations are homogeneous across agents. That's my first point. But however, there are periods it may not be true. Why? When this average doesn't go to 0 or doesn't go to constant, goes to random variable. Okay, let's just now move on and very quickly see what conditions there are. I've spent a lot of the last 10 years looking at large dynamical system, actually understanding what happened to cross-section averages. Whether these cross-section averages go to a limit or not. The difference between looking at cross-section average and time series models is that in time series we have time ordered. So you got there are orders, and then we say as we go further to the past, the dependence declines. But if we deal with individuals, you can't order individuals. I mean, how do you order traders in the society? So you can't tell the distance between them. You can't have a central limit theorem which says, look, the dependence decline. In fact, there's no reason to believe that the dependence declines. Sometimes it could actually accentuate. For example, in this hall, suppose normal condition, people leave this room, nobody bashes to each other, nobody gets hurt. But then in some condition, the same people sitting in the same room, maybe more people, because lots of empty spaces, but shout as fire, it could be people trampling out of the room. The correlation between you guys changes quite dramatically. So therefore, this argument that somehow the correlation of the individuals, their expectations and so on, is somehow are very weak or independent of each other is not holding. So therefore, the condition under which this goes to the true value, remember this is what we are working with, under heterogeneity, this is what this objective reality is. The condition under which these go together when M become large. Of course, if the trader is not enough traders, you won't never happen. I'm dealing with when there are lots of traders, so the markets are thick. If you deal with thin markets, it's not going to hold. So therefore, that's why thin markets, you could have predictability, but cannot exploit it. But I'm dealing with the cases where the markets are thick, so M become very large. So it's possible that this will not go to 0, and some condition could go to 0. So the idea is that there are in periods where traders' individual experience become strongly correlated. I'm now going to explain what I mean by strongly correlated. There is no reason why this will become negligible. And that becomes a wedge between what people talk market efficiency and what predictability could arise. So you could have these inefficiencies in the market. Markets could also display inefficiencies without being any profitable opportunities, because this could be non-zero, but there is no stable pattern in the XI, because the correlation which creates this across agents, which creates this non-zero value, may change. One more thing you get up because of psychology of the market, or behavioral, what they call behavioral finance, it could be explained through that. Behavioral finance, if you want, is not just changing the terms of utility function that some of my colleagues do, but actually to understand the correlation of traders. Why is it sometimes traders become more correlated with each other? When I used World Hedge Fund, the company took enormous care so that Chinese walls are built so people don't talk to each other, so the traders don't become correlated. But still they talk to each other, they talk to others, they read the same newspaper. They are human beings, they panic. And we all human beings panic together. We don't panic separately, independent of each other. So therefore it is so important to abandon the assumption that all agent expectation equalize. I'm not suggesting agents here are not rational, by the way. My agents are perfectly rational. They form expectation given their own information set, given their own beliefs. But that expectation need not be the same across everybody in the room. There is nothing on earth to justify that we form expectation become all the same.